안녕하세요. Ladies and gentlemen, welcome to session 1. My name is Dae-ung Lim. I am the moderator of this session. I am the country coordinator of United Nations Environment Program Finance Initiative, and also the CEO of Eco and Partners 2 degrees Celsius. Today's topic is the importance of ESG disclosure. We have 4 honorable guests from my side. Mr. Kim Dong-soo, Executive Director, Sustainability Management Initiative of Korea Productivity Center. Jonas von Oldenskiöld, the Head of Swiss Re Korea and Chairperson of European Chamber of Commerce in Korea. And Mr. Kim Jin-sung, Team Leader, Senior Lead Analyst, Korea Corporate Governance Service. And Thomas Dodd, the Policy Officer, Non-Financial Reporting, the European Commission, on the line. Is he on the line now? As you all know, the last month, G7 agreed to introduce a mandatory TCFD disclosure system. They also officially adopted the TNFD initiative, which is a financial disclosure related to biodiversity. And before that, the European Commission introduced the non-financial reporting directive and recently published a draft bill on corporate disclosure related to the EU taxonomy. The United Nations also has a firm stance to support the effective ESG disclosure of large and listed companies. The UN encourages companies, financial institutions, and stock exchanges to adopt mandatory disclosures. We can say that it is the age of ESG disclosure. Now, I would like to invite Kim Dong-soo of Korea Productivity Center as a speaker. Mr. Kim, please give us your presentation.
Good afternoon, everybody, and thank you to Mr. Im Dae-ung for the introduction, and also, great honor to have this discussion with distinguished guest panelists. I'd like to discuss about ESG disclosure trend and the key agenda for the discussion. As end of 2020, 135 organizations in Korea published sustainability reports, and 87 companies out of 135 are listed. This represents only 10.9% of listed companies, but the number rapidly increased starting in 2020. And this year, we expect around 150 publications. Moving forward, it is important that we are aware this figure has to increase approximately 25% each year until 2025 in order to meet the new rules of the Financial Services Commission. The new rules will obligate companies listed on the Korea Stock Exchange with total asset over 2 trillion Korea won and rest of the companies by 2030. There are voices demanding early adoption of these regulations, but at the same time, it is equally important that we need quality ESG disclosure rather than ESG disclosure itself. It is interesting to see trends in companies publishing reports, both with ESG title and content structure aligned with ESG in these days. Another interesting trend is the rising adoption of TCFD and SASB. In 2019, only 5 companies applied the TCFD recommendations, which increased to 22 the previous year. 4 companies applied the SASB standards in 2019, which increased to 19 last year. It increases rapidly. That's what we can witness. And this year, for both TCFD and SASB, we expect the figure to double to approximately 35 to 40. Meanwhile, the number of companies aligned with UN-affiliated initiatives remained relatively static. We are also witnessing that companies are dividing their sustainability report into substructures. For instance, Fold not only publishes the sustainability report, but also different types of sub-report that is material to their business, such as GRI, CDP, TCFD, and Bloomberg Gender Index, which was very interesting to me personally. And this implies that companies are not only focusing on materiality issues, but also proactively finding effective method of communication to respond to their demanding stakeholders without communication errors and publicizing that they have fulfilled a certain criterion. Just like you ask the TCFD, here's the TCFD. You ask for SASB, here's the SASB, which helps the companies to eliminate certain errors. Some companies even provide the ESG data sets, like a Hyundai Motors company and Wells Fargo, such as, for their stakeholders, including investors. Going beyond this, however, we are now seeing increasing cases of global companies publishing standalone diversity reports. As a few examples here, we have included Netflix, Google, and General Electric. What this indicates is that A, it is obvious that companies are responding to stakeholders' demand for more and better. B, companies are taking materiality issues more seriously than ever before by communicating their performance in detail. And C, in my personal opinion, it is my personal opinion, all these phenomena indicate that companies are also under huge pressure from all sides in terms of ESG disclosures. Thus, we need to find an effective way of doing it. Again, what we need is quality of ESG data rather than just the ESG data. This cannot be the sole solution, but part of it, in my opinion. There is a growing trend of companies participating in ESG web reporting. ESG web reporting is not a URL to show ESG data on the website. It is a system that represents the corporate ESG data from individual departments within the company. So all of these data is collected from each department and disclosed online in real time, eliminating the need of corporate internal complicated processes. For this next part of my presentation, I will take briefly about trends in reporting frameworks used for ESG disclosure. For many years now, corporations have faced with the difficult task of responding to many different ESG disclosure standards and principles. We hear similar complaints from investors as well. Complaints from companies, complaints from investors. It's at the same time. Lack of comparability, materiality, and completeness, and poor assurance, and less financial relevance is the common feedback from many. Korean companies are applying GRI and IIRC the most, but recently SASB and TCFD have been receiving strong attention, as I mentioned earlier. However, WEF is relatively new, and we have not seen official adoption of the WEF framework yet, but possibly in the near future. Next is convergence. I say this because the alignment of global ESG disclosure standard is rapidly gaining momentum for both financial and non-financial reporting regimes. In March, the IFRS announced the development of a sustainability standard board and formed a working group consisting of the IASB, TCFD Value Reporting Foundation, which consists of SASB and IIRC, and CDSB and WEF. This group will closely with CDP, GRI, and IOSCO. In addition to the convergence of global standards, we are also seeing more countries adopting regulations for voluntary and involuntary ESG disclosures. Private sector actors, such as institutional investors like BlackRock, are engaging companies for ESG disclosure too. Now the trend is comply or explain, but it is moving more towards mandatory for certain indicators or a specific framework. Stock exchange is another interest group. At the end of 2019, 23 exchanges had systemized ESG disclosures, and 48 had proposed the ESG disclosure guidelines. Many people ask, what's next? It is difficult to predict, but the TNFD, like Mr. Im mentioned, is gaining strong attention as the concept of a circular economy becomes a buzzword. This is a global initiative which aims to give corporations a complete picture of their environmental risks and to shift the global financial flows away from nature negative outcomes and toward the nature positive outcomes. It is recently backed by the G7 earlier this year and aims to deliver a reporting framework by 2023. So far, we have discussed the corporate ESG disclosure, but now stakeholders' attention is moving to financial institutions, not just for the company, but also financial institutions. In March 10th this year, the EU's Sustainable Finance Disclosure Regulations, called SFDR, came into effect, requiring financial institutions operating within the EU to disclose their sustainable finance policies and setting specific rules for how and what sustainability-related information they need to disclose. I think the SFDR will have a major impact not only on those financial institutions, but also on stimulating corporate ESG actions, including disclosures. In the public sector, the EU leads the way when it comes to facilitating the transition to sustainable growth and better ESG disclosure. Looking at the plan, we can identify 10 items for action. In terms of non-financial reporting, down there, amendments to the financial influential and NFRD will be effected to enhance the quality of a corporate ESG disclosure. Last November, EU released a study on sustainability-related ratings, data, and research, and found that there is a lack of consistency in ESG assessment result. However, rating agencies are also claiming it is difficult to climb the mountain of ESG without more and better ESG information. Next is ESG disclosure key agenda. One of the critical issues in ESG disclosure is defining the disclosure boundary. Completeness is an important element of ESG disclosure, but partial disclosure is still our reality. Selective disclosure is another issue. As we can see, some companies disclose the entirety of their domestic and overseas operations, whereas some companies do not. Selective disclosure occurs when companies choose the materiality issues as well. Next, who is responsible for the ESG disclosure? At least for this agenda, there is a growing consensus that board should take responsibility. But it seems Korean companies are getting behind. A large number of Korean companies, the board just received report, but did not approve. Another agenda is we also know that third-party assurance is important as capital market participants and other stakeholders seek credible, transparent disclosures that they can have confidence in. We may see an increasing demand for assurance in the ESG disclosure landscape. As the example of the need for assurance, we have compared two sources of corporate ESG data for Korean company. One source is sustainability report, and the other is Bloomberg Terminal. For 5 different metrics, there are many discrepancies between two data sources across a 5-year period. And for some metrics, the difference is substantial. So it is inevitable that stakeholder demand for quality assured ESG information is growing. This session is about the importance of ESG disclosures, and it's a trend. But if we focus only on ESG data, we limit ourselves to taking only about a few sets of ESG data. ESG disclosure is more than that. It is about corporate long-term financial maturity and value creation and corporate stories behind what you can see in financial reports. I think ESG disclosure is important because ESG disclosure is the starting point for the ESG ecosystem whole landscape, such as investor decision-making, assessment agencies, and assurance bodies, even companies themselves. It is important that we must understand that ESG disclosure is not just the disclosure by the company, but it is a starting point in the whole landscape. Thank you for your attention.
Thank you very much for your insightful presentation. It is regrettable that the ESG report have hardly increased in Korea between 2013 and 2019. Until now, the Korean government and industry's stance on ESG disclosure is voluntary basis. As Mr. Kim pointed out, despite the passage of much time, the lack of ESG disclosures can be interpreted to mean that the current voluntary approach was not quite effective. We have Mr. Kim Jin-sung. I know his company, the Korea Corporate Governance Service, is an ESG rating agency in Korea, and you are utilizing and analyzing the ESG information. So how do you think about the quality of ESG disclosure of Korean companies, and what are your recommendations about ESG disclosures?
Hello, thank you for inviting me. I'm Jin-sung Kim, working for Korea Corporate Governance Service, and I will share some comments on the presentation and the general situation of ESG in Korea. Since last year, ESG management has become one of the most talked about topics in Korea as well. With this, non-financial data, the metrics of ESG management, is also gaining prominence. There is a growing body of various research and analysis on the impact of non-financial factors on enterprise value. Major economies, including the EU member states, are expanding mandatory non-financial disclosure. But we cannot deny that it is a burden for companies because there isn't any standardized sustainability reporting framework yet. For this reason, in overseas markets, efforts are underway to make standards for non-financial reporting framework. Here, we also need to bear in mind the fact that ESG is becoming a critical factor, not only from a regulatory perspective, but also as a financial channel. While green bonds are mainstream in the bond market, social and sustainable bonds are also expanding more recently. Also fast-growing is the sustainability-linked loan market, which can provide yet another financing opportunity for companies. Now, financial institutions are increasingly referring to ESG rating data, and this requires us to take a keener interest in ESG ratings, as well as enhancing the rating framework. What do all these say to domestic companies? If you act preemptively, you could reduce risk and cost. ESG disclosure is not simply about providing relevant information. It can transform the focus of business management towards an environmentally conscious, socially responsible, and governance-centered one. Other than companies, investors engaging in responsible investment are also important actors in the ESG disclosure landscape. What is also important is for investors to disclose their ESG policy and ESG-related investment strategy. Recently, the Korean government also takes an interest in ESG and sends a positive signal by coming up with various measures. Yet, a systematic and concerted drive seems more necessary because a potential competition between different ministries may cause confusion in the market. In this context, the EU case is a good reference point where NFRD, SFDR, and taxonomy are working as mutually complementary regulatory regimes. The Korean government should also work on a concrete master plan for ESG disclosure, drawing on its experience on governance reporting and referring to the EU case. That way, the government can provide a predictable path for the companies and investors having a stake in the Korean market. And the companies, that should produce disclosure will be given time for stepwise preparation. In overseas market, separate from the expansion of mandatory ESG disclosure, the global standard setters are working together for the standardization of non-financial ESG reporting. The standardization of ESG disclosure frameworks increase comparability, compatibility, and repeatability, and thus provides an opportunity to raise the usefulness of ESG information and reduces companies' burden for information management and other responses. Meanwhile, a standardized ESG reporting framework may expedite the legalization of non-financial disclosure, and then it is likely to act as a trade barrier. If not legalized, it may still work as a soft law, becoming a conduct norm for Korean companies need to follow. So we need quick actions in our response to the standardization of ESG reporting frameworks currently underway. First, we need a comprehensive study into the existing standards for ESG-related non-financial information and understand the details of the efforts to standardize ESG reporting underway in overseas markets, along with ongoing monitoring of the progress. And then we should share the progress and developments with the industry and financial sectors. Next, we need to draw on our experience from the IFRS adoption and implementation when we analyze the impact of standardized ESG disclosure on our activities with overseas markets, investment attraction, company management, and so forth. Then we need to hammer out necessary measures and an effective response scenario. Based on the analysis of existing standards and our plan and response scenario to be prepared, we need to actively engage in the discussion about standardized ESG reporting. In conclusion, Korean companies should pay attention to the global efforts to standardize non-financial disclosure, since a global standard, if created, will have a huge influence on the major economies across the globe, as well as domestic companies and investors. In this regard, the government needs preemptive actions to make it compatible with the global standard non-financial disclosure framework, so that Korean companies can take advantage of ESG reporting as an opportunity. Thank you.
Thank you very much. We have Thomas Dodd of European Commission on the line. Hi. What do you think about the voluntary approaches in Korea? And can you share your view and experiences on mandatory ESG reporting in Europe?
Good afternoon. Yes, I can try. Thank you. And please forgive me beforehand. I will need to drop off immediately after this intervention. I think that the background of what the EU is doing has already been well presented this morning. We're looking at this in the broader context of the European Green Deal, of the goal of carbon neutrality, and in the context of a number of existing pieces of EU legislation on sustainable finance, including the taxonomy and including what we call the Sustainable Finance Disclosure Regulation, that is ESG disclosure requirements on the financial sector, on asset managers and financial market participants. In that context, what I and my team deal with is corporate sustainability reporting. We have some existing corporate sustainability requirements in the EU today. They have been in force for approximately 3 or 4 years. They are not very detailed or prescriptive requirements. In other words, they leave quite a large amount of flexibility to companies to decide ultimately what to report, a very large amount of flexibility. They only apply to quite a restricted group of large companies above certain thresholds, including above 500 employees. And they are not accompanied by any kind of audit requirement. Now, and I think this may also help to answer your question about a purely voluntary approach to corporate sustainability reporting. Our analysis is clearly that our existing requirements today are inadequate. The ESG data needs, the growing ESG data needs of users, mainly the financial sector, are clearly not being met, with all kinds of follow-on implications, including for the stability of our financial system and the achievement of our sustainability goals. Certainly from the EU perspective, a purely voluntary approach to sustainability reporting is unlikely to work. At least we don't see that it would have worked in the EU context, and we are very clearly now moving in the other direction. In April this year, the European Commission put on the table a proposal to revise and to strengthen our corporate sustainability reporting requirements. And that is a proposed corporate sustainability reporting directive, what we call the CSRD. That is now being considered by the EU member states and the Parliament, and we hope that sometime in the first or second quarter of next year that they will reach an agreement on this proposal. Our aims are really twofold. Firstly, to make sure that user needs for ESG data and information are properly met. That means that information needs to be comparable between companies, information needs to be complete, and information needs to be reliable. On the other hand, we also are seeking to address a number of problems that come from the preparer perspective, that is to say, from the perspective of companies who produce and publish these reports. While it is clear that new EU rules may lead to a certain increase of costs for reporting companies in the short term, it's also true that the current situation is simply not an option, even for reporting companies. We hear increasingly that they suffer from multiple different expectations from different stakeholders, different requests to use different frameworks with different metrics. The situation is highly complex, it is confusing, and in our view, the current situation of multiple overlapping, sometimes consistent, sometimes not consistent reporting frameworks is not tenable. And that is something that we need to address also in the interests of reporting companies. The main elements of our proposal, there are really three main elements to it, although there is more to it than that. Firstly, we're proposing to significantly expand the number and the kinds of companies that would be subject to these requirements. The easiest way to think about this is that we are proposing that all large companies, so all companies that are not SMEs, that is with more than 250 employees and certain other financial metrics, would be subject to these requirements. And also all companies listed on EU regulated markets. So that would include listed SMEs would be subject to these requirements. We estimate that we would be talking in the region of 50,000 EU companies that would be subject to these requirements. The second major part of this proposal is that we propose to introduce an audit requirement. It would be introduced gradually. The ultimate aim would be to have similar audit requirements for financial and sustainability information, but for various reasons it might take some time to get to that point. The third and the most important part of this proposal is that we are proposing mandatory EU sustainability reporting standards. Our proposal is that those standards would be developed by a body called the European Financial Reporting Advisory Group, EFRAG, and they would then subsequently, under certain conditions, be adopted into EU law. Now, these EU standards would be comprehensive in the sense that they would cover the whole ESG agenda. They are not, for example, just about climate, nor even just about environment. They would, for example, also cover human rights issues, supply chain issues, related governance issues, and so forth. Secondly, and this is an important part of the EU approach to sustainability reporting, they would explain to companies how to report about, first of all, how sustainability issues might impact and create risks for the company, but also to report about the impacts of the company itself on the environment and on people. This is sometimes referred to as the double materiality perspective. The initial materiality from financial reporting obviously being you report it if it affects the financial performance of the company. That perspective remains, it's legitimate, and it's also important to sustainability reporting. But there is another perspective that says, please tell me objectively about your impacts, irrespective of whether and how those impacts might have a knock-on effect back onto the company. So that double materiality perspective would be built into these standards. The last point I wanted to make is about the link between what is happening at global level and the development of EU standards. We fully support the goal of greater global alignment and of initiatives to create a baseline set of sustainability reporting standards at global level. At the same time, we also need to be consistent with our own legal framework within the EU, with the Sustainable Finance Disclosure Regulation, for example, with the taxonomy, for example. And we also need to be consistent with our own political reality in terms of the level of speed and ambition with regard to the sustainability agenda. The IFRS Foundation, for example, has said that it will start work on climate. It will move according to an uncertain timetable to certain other unspecified or as yet unspecified sustainability issues. While we welcome all progress in that direction, we don't think that we can wait for that. We don't think that we should accept that our pace of movement on sustainability is dictated by what ultimately is likely to be a lowest common denominator approach under the auspices of the IFRS Foundation. So we will ensure that EU standards both build on what is happening at global level and contribute to it. This should be a two-way process. Coherence and interoperability are, of course, important priorities. And it will involve quite a lot of contact and technical work to build these things together. Thank you again for inviting me to contribute to your discussions today.
Thank you, Todd. It's almost time, and before letting you go, I would like to hear your last comment on TNFD from G7. Actually, it is hard for companies to respond to even TCFD. And what would be your recommendations for Korean companies to prepare the TNFD report?
I'm going to sort of answer the question sideways, which is not to make any specific comment on the TNFD as such, and anyway, it is only an initiative under development, but perhaps just to raise a flag that we already have a very large number of reporting frameworks on different issues. And while it is critically important, I let there be no doubt about this, it is critically important to integrate into reporting standards all issues about impacts on nature and dependencies on nature. We do need to be careful about creating yet another framework. What I fear is that then the next conversation that we have with companies subject to these requirements will go, hang on, it's not just TCFD and SASB and the GRI and the CDP anymore. It's now TNFD as well. And it does become important at some point to make sure that we are working towards one coherent set of standards so that companies don't have to consult 3, 4, 5 potentially overlapping standards in order to produce consistent data. It's a big challenge. It's not easy for any of us, but from our point of view, it is important to do that. And indeed, that's something that we hope to be able to achieve through the development of EU reporting standards. We would hope that EU companies would then not have to constantly refer back to a multitude of other initiatives.
Thank you very much. Stay in touch. And we have Jonas. He's the head of Swiss Re Korea. I know Swiss Re is one of ESG leaders in insurance sector. And how do you see the value of ESG integration into underwriting and investment for insurance company?
Yeah, thank you so much, and thank you both KCCI and ECCK to having me today. So absolutely, I'm going to try to make this maybe a little bit more concrete and how does it impact an industry specifically and the insurance industry. And the good thing with the insurance industry, I think it's very well equipped for handling ESG questions. It's actually one maybe best of the industry to handle that, because if we look through what ESG is about, it's really about handling risks. And that's what we do. That's our bread and butter. That's why insurance industry exists. Of course, there will be some uncomfortable discussions around that and uncomfortable decisions made through that. But insurance industry is quite equipped to handle those things. So to make this a little bit more concrete, there are 3 areas where the insurance industry is impacted. There's the underwriting side, that's when we take risk. It is the operational side, that is our day-to-day living and our relationship with our stakeholder. And this is our investments operations. And I will try to explain what currently happen and what the current challenges are for the insurance industry to integrate ESG through these areas. So starting with the underwriting side. For us that experienced almost 50 days of rain last summer in Korea and a record cold winter followed by that, I think there's no doubt that there are some changes going on in weather. Exactly how and when they happen is very difficult to statistically define, but we can see over time there have been more extreme weather happening. Over the last 22 years, 20 of these were record warm years, according to statistics. What that means is that, of course, it has an impact on economy overall. We have done some research and looked at what happens if the world do not achieve the Paris Agreement or the signatories to the Paris Agreement. We can see that up to 18% loss of GDP by 2050 through rising sea levels, decreasing crop yield, decreasing tourism, heat stress on humans, and a couple of other factors. Also for Korea, this is not irrelevant. We see numbers up to 12% according to our calculation if we don't achieve to stop the change in temperatures. That, of course, had a direct impact on our balance sheets, the risk that we're taking. So as an insurance company, we take risk and we are ready to pay when something occurs. That's when we deliver our product. But to understand the risk for the future, we need to, of course, take a little bit more cautions currently and reflect this into our models. So most companies currently doing that in different way. They're stressing their various scenarios. They have stopped insuring some sectors. Companies typically go out and avoid some of their thermal energy productions. There are also some consideration on where you can be insured and where you cannot be insured. Below certain sea levels is questioning. There is problem for companies living on tourism where they need snow. Because you cannot produce that today anymore in some places. So all this comes into account in how the underwriting model changed. There's more sophistication into this, but I think it's very important for the insurance industry how we reflect this. We have spoken quite a lot today about data usage and the importance of reporting. As a big consumer of data, to have this reliability, I steal the word from a previous presenter here, that's very important for us. We need to understand that, and we have struggling quite a lot to get this detailed information from a lot of our policyholders. More disclosure on data will help us in that sense and also build a larger general understanding of these risks. So that's the underwriting side. The operational side, I think there as a service company providing mostly services, our biggest contribution is our people when we commute to work and those kind of things. So in the end of the day, as a service company, we're not a big contributor from a carbon perspective. But this is another topic that each and every one of us need to work on. In the past, it was enough to buy credits, carbon credits. Now everybody speaks about net zero and actually how you take out carbon from the atmosphere. And I think there is an area where a lot of insurance companies are spending more and more time on. The last area where insurance companies have been quite active and continue to be active is on the investment side. And as one of the largest institutional investors globally, the insurance industry has a significant impact. Most companies today is actually steering their investment portfolio, both what they're managing for their own balance sheet, but also what they're managing for the policyholder as a fiduciary. The lack of data and transparent data and rating has been a concern for many. So therefore, most large insurance companies have now gone together in the Net Zero Alliance, Net Asset Owner Zero Alliance, trying to steer those values more details. So the insurance industry welcome further transparency by all means. But as you see, what I try to explain is that insurance companies are quite equipped to handling ESG as it is to mitigate risk ultimately. I wanted to pick up a little bit on ESG disclosure. And again, I'm going to speak now a little bit more as a company representative and what the challenges actually are day to day there. Our first note around sustainability, I know I'm switching a little bit between ESG and sustainability. It's just different languages, I guess. But we made a first note 1979 around sustainability and the impact that will have for our operations. I think the disclosure in itself, that's not the challenge. The challenge many companies stand in front now, despite the multiple different standards and regulations that we're seeing, which you need to handle and need to be more unified over time. The challenge is disclosure is only your receipt of what you have achieved during the year. So for a lot of corporations, you need to now to start actually deliver on what you promise. It's not anymore just the marketing. Stakeholders, including investors, regulators, and employee organizations, get more and more sophisticated trying to actually understand what those disclosures are about. So when you're producing your disclosure, you actually need to look through your whole business model, including your governance and ultimately your compensation framework. Because these topics cannot anymore just be a marketing report. It actually needs to be part of your overall business model. And this is very uncomfortable for many companies, and it's very complex as well to bring it together. But I think that the future for disclosure is not to create more standards, it's actually to try to adapt to them and adapt to them throughout the business model. And I think I stop there.
Thank you. Well, still there's a lot of room needs to be improved. We all understand today in today's discussion, consistency, comparability, relevance, and reliability are the key words that we really need to improve our quality in terms of ESG disclosure. However, I never see or hear that companies are saying that, hey, we are going to manipulate the ESG data. No, that's not the case. In many cases, companies are suffering to deliver the information that market demands because different standards and guidelines and also different interest groups. Now, it is a question not just to the companies, but also other stakeholders, such as regulators and policymakers or other institutions related to ESG disclosures. Now, all these stakeholders need to answer to the companies to help and assist better quality assurance ESG data. And the second thing is I'd like to ask and urge everybody to see this not as a trend or not as an outcome or a result, but also progress and procedures. And it's a long journey. We have to climb the mountain together. It's not a small mountain you can see, around you. It's a huge mountain that we have to climb all together. And in order to achieve it, I'd like to urge you to see this not just a sustainability report. It's a reporting, and we are making the progress, and we have to. And also, it's a long journey. Since it is a long journey, we have to give time to the market and to the companies, because there's a question whether do we have a high quality assurance body that can deliver high quality service. Yeah, of course there are some, but we still need more time that market service grow. And we have to cultivate the ecosystem for ESG disclosure. And another thing is it is important to see not as just a report, but also see as a ESG disclosure whole landscape. And it's no longer it's a sustainability report. Now, investor needs different information, and also regulator needs and NGO needs different information. Now, it's a much bigger piece of things. So we have to see this as a whole, not just a sustainability report itself. Last, I think it is important that we also understand that our part of the journey must pay attention to small, medium enterprises as well. And we, a lot of sustainability report that we see in our daily life is, mainly from large corporations, but small, mediums are always getting behind in this discussion. And we have to get these small, medium enterprises on board.
Great, thank you. Today we discussed about the global trend and the importance of ESG disclosure. We also talk about voluntary and mandatory approaches in Korea and the EU. Along with TCFD, we talk about the emerging TNFD. And there was also a recommendation that we have to focus on the ESG disclosure of small and medium-sized enterprises. I hope today's discussion will be helpful for Korea and EU to promote ESG disclosure in an effective way. Thank you very much, Kim Dong-soo and Jonas, Kim Jin-sung and Thomas. And thank you for being with us today. 감사합니다.